Hello again, everyone. It's Vince Vora from TradingWinds.com. And today I want to talk to you about a professional money management method that not many people are aware of. But if you've ever wondered how some money managers consistently beat the S&P 500, I'm about to show you how. It is a very simple technical analysis technique that involves really one simple indicator, just a simple period moving average. Let's get to the charts and have a look here. What you see here is a chart of the SPY, which is the ETF for the S&P 500, a broad market index. And the white line is a 10 period simple moving average, as you can see here. 10 period based on the close. That's all. So now we're on the monthly time frame. This is usually used with the higher time frame because it's meant more for investing rather than trading. Now I'm going to show you how to do both with it, but I'll start off with just teaching you this method for more of an investing approach, something you would use to manage a portfolio, especially a retirement portfolio, or manage money for others. So before I get started, this works with anything, whether it's individual stocks, an index like the S&P 500 or the NASDAQ 100, etc., forex, crypto, anything you can chart on. It's based on simple technical analysis. Okay. And the reason why this 10 period moving average works as well as it does on this time frame is because it takes into account about one full year of trading. If you think about it, it goes back and looks at 10 bars, right? Each bar is 1 month of trading. So it's about 10 months of trading. But if you factor in weekends and holidays, that's about one full year of trading. And that's why this works as well as it does. So it's as simple as when price moves above that 10 period moving average, you would consider going long on that stock or buying that investment and holding it until we get a close, not a trade, but a close below the 10 period moving average. What do we do when it is below? We do nothing. Okay. Now you can use this if you're trading stocks actively, you can go short when it is below the 10, but that is not how money managers use this. What they do is they put their clients' money to work when price is above the 10 MA, and they move their clients' money to cash or other investments like fixed income and so on, safe, uh, much safer investments when it is below that 10. And when it crosses back above, they put their money to work again. Okay. Now, again, you can put together a portfolio, different stocks, in combination with some fixed income, et cetera, to balance the approach for and tailor it to the individual. Or you can just use this as a stock selection tool as well. Why does this end up beating the S&P more often than not? Well, because there are pullbacks, right, that we don't get hurt on. So in other words, usually the way they track the S&P is they look at the start of the year and they'll look at the end of the year, right? Now I know this is the monthly charts, many more years in here than just 1 year. But just to give you an example, if we were to chart this and say, okay, we began the investment period here and we ended here. You can calculate how many points that is. But the reason why this ends up beating that is because when you pull back like this and then you get back in, you're out of the market here. So you don't take that loss, but then you're back in here and you take that gain. So if you've already had a gain in this portion, now you're getting that same portion twice. You're getting it again here. And that's the addition or that piece that ends up giving you a better return than just holding from here and exiting here, right? And so, for example, you had this rise up to this point, and then you got back in here, etc. So Anyway, this chart isn't a great example just because there's very few pullbacks. We have been in a bull market for a very long time here, but on individual stocks, when you get those moves below those dramatic drops and then that recovery period, you're only participating on the one side, on the long side. So in the long run, it ends up working extremely well. And it is really that simple as following a line on your chart. So S&P 500, NASDAQ 100, again, if you're long, when you're above, you're out of the market. You're in cash or other investments here. You're back in when it's on. And sometimes, you get some quick outs. Not every trade is going to be a winner, but for the most part, what you will see is more winners than losers, but dramatically bigger winners than losers because you are out here, for example, you don't participate in this, right? While this is happening to the overall market, you're in fixed income or other investments that would be doing well. And you miss this part, you don't feel the pain there, but then you're back in here and you accomplish that gain, right? It works very, very easy. Let's look at individual stocks like Apple. And again, you're in Apple when price is above. When price is below, you are not in Apple. Okay. And then you're back in and you participate in that gain. And you're back out. You don't do anything here. You're back in here and you participate in that gain. Okay. And so, of course, the better the stock, the better the performance. Yes, absolutely. You can marry fundamental analysis with technical analysis with this point. Remember, this is just a timing tool. That's what this is. When price is typically above the 10, when it is above the 10, okay, typically it goes higher, right? It usually goes higher, and that's why we want to be long. When it's below, it usually goes lower, which is why we want to stay out of the market at that point. So it's a timing tool. That's it. It doesn't tell you what the company's earnings are like, what their sales are like. You can use other sources for that. Come up with a watch list of some of the best companies out there, and then use this tool to time the market. Let's look at Amazon over the years. How would it have done on this? Obviously, much bigger wins than any loss, right? So if you get in here and you're out here, yes, that's a loss, but it's a small loss in comparison to these huge wins. Okay. And that's what this is all about. Again, you can use it on anything, whether it's an index, whether it's a stock. Let's look at Bitcoin. Okay. No one's saying you have to use it on Bitcoin, but hey, if you like crypto, it works the exact same way. You're in during the runs up. You do not participate in the runs down. You're back in here, you're out here, and you're back in. And when you catch a big run like that, it will more than make up for many, many, many small losses. And again, here's another great example of why it's better than just buy and hold, right? If you had bought here and it moved up here, okay, you'd have pretty much the same gain as you would by holding until now, where it's back to the same spot, right? But if you participated in the up move, you missed this part, but then you participate in this. Look at from here where you got in, right? That's about here at this point. So you made that gain, and now you get another piece of that throughout this run, right? That's why it's so effective. Now, what if you don't want to trade on the monthly time frame? What if you want to do more trading than investing? Well, you can lower your time frame, but if you do, I would suggest you change this moving average. And let me explain. I'm going to split my chart into three here. What you see here on the top is what I was showing you before, which is the monthly time frame with a 10-period moving average. In the middle here is a weekly chart. Now for the weekly, again, remember, we want to get about 1 full year of trading in here. So what we do is we change that moving average here to a 50-period moving average based on the close again. Why? Because each bar is 1 week. Okay. That means we're looking back 50 weeks, which again, when you include weekends and holidays, is about 1 full year of trading. And then we break that down even further. If you'd like to go to the daily time frame, we change this line to a 200 MA. Okay, so that means it's looking back 200 bars. And again, that's about 1 full year of trading when you include weekends, holidays, etc. So, and to prove it, you can see here that if I hover, I want you to look at my crosshairs, right? These lines, the dotted lines that appear on all three, they're synced. So if we're crossing here on the daily chart above the 200 MA, you can also see at the same time where my crosshairs are on the weekly here, it's crossing above as well. And over here on the monthly, it's crossing above. See how that happens at the exact same time? That's because they're each looking back about 1 full year of data. So again, on the monthly time frame, you want to use a 10-period simple moving average. On the weekly time frame, you want to use a 50-period moving average. And on the daily, you're looking at a 200-period simple moving average. That is it. It is very simple to follow. Doesn't take a lot of time. You can bring up any chart and have a look at the other good practice to do is to look at the different sectors of the market. And these days with ETFs, it is very simple. Let me go back to one single chart here. This is the monthly. So here are the sectors, right? Energy, financials, technology, etc., right? Consumer staples, utilities. There's about 12 core ones, right? Now, if we switch our time frame, all right, and go say to the daily on this one, again, remember, we'd have to change this MA on the daily to 200. Okay. And there it is. Now, let me make sure that is, no, that's a 20. Let me add another zero there. There we go. That's 200. So now you can see that we were below here. We would have been out of the market here. Now that we're crossing back above, when we're back above, we'd be getting in the market here. Okay. And if you go back, okay, look at all the drops in the market here, we would have been out of all of that. But on the long runs, here to the upside, we'd be in there. Now, there's many more techniques you could use to time this a little better. Of course, there's so many different technical analysis techniques that once you're in, you can identify, areas to take some profit along the way. You can add a shorter term moving average, right? A very short term moving average, so that you don't let it come all the way back to the 200 like that to exit. You get in when you catch a nice run, you're out here. So if you put a 10, a 20 period moving average here, for example, and you're only trading when price is above that 10 or 20, but also above the 200, right? And out when it crosses back below that 10 or 20. That way you keep the profits that you made here. You don't end up giving them back. There's many other techniques, but remember, this was meant to be traded on the monthly for longer term periods, okay? And with the 10 period simple moving average, money managers have been using this forever. It continues to work extremely well, and it is very, very simple to spot and to use. I hope you enjoyed the video. Thank you again, and we'll see you on the next one.